So today I want to think about retained earnings. And I think a lot of people out there think about retained earnings in exactly the opposite way of reality. So let's start with just regular basic earnings. Okay. This is simply revenues minus expenses. We can also call it net income. We can also call it profit. Now, these earnings are the property of shareholders. Now, oftentimes a portion of these earnings are paid out in the form of dividends. I have a video out there about dividends you can check out here. I talk about the types of dividends, talk about the tax consequences of these dividends, and I also give you some of the highest dividend yielding companies out there currently in the S&P 500. Now, the net earnings or profits or income that isn't paid out by the company is considered retained earnings. Okay. And this goes to the balance sheet. In fact, we just keep a running tab of this. So the new retained earnings is whatever it was at the beginning, plus or minus, profit or loss, minus those dividends paid out. And this becomes retained earnings on the balance sheet. Okay. Now, one thing I hear way too often is, we're talking about some project or some whatever it might be, and we're like, we need to pay for it. How are we going to pay for it? And someone will say, well, let's use our retained earnings. We got all these retained earnings. Let's just use them for the project. Now, let's go back and look at the accounting equation, right? Assets equal liabilities plus owner's equities. Now, what does that represent? Well, that represents what the company actually has, what it owns, what it belongs to the company. Liabilities, that's what the company owes to creditors. They don't have it, right? They owe it to someone else. And if you go to owner's equity, that's also what the company owes to shareholders. It's not an asset. So the left-hand side, company owns, can use, etc. What's on the right-hand side is what the company owes. It's worse than not having it because you actually have to find it and pay it out to those people, right? Now, if we go and break that down, what we're going to see here is retained earnings is over here in shareholders' equity. It is an IOU to shareholders. You can't spend something that you don't even have. You can't spend something that you owe someone else. You just can't do it, right? So you can never use retained earnings to pay for something because it is worse than not having something. It's actually something that you owe someone else. Now, the only place you're going to find something that you can use to pay for a project or whatever is on the asset side of the balance sheet. This would include things like cash. I hope that clarifies that. I hope you don't make that mistake again and think that companies have this retained earnings pool, which is the same thing as cash that they can spend because it's exactly the opposite of cash. It's an IOU to shareholders. I hope you enjoyed that. Thanks so much. I'm Brian Kozlowski.